Today is Friday, July 8th, 2016, and this is the ADM Investor Services Weekly Market Review. Today's guests are Alan Bush, Senior Financial Economist here at ADMIS, and Steve Freed, Vice President of Grain Research. Steve, we have seen a steep drop in grain prices. Why is that, and can they recover?
After the 4th of July weekend, we saw rains move across most of the Midwest, and these were timely rains, and the amounts should help the crops. So for those investors that got in the long side of corn and soybeans because of La Nina and the possible drought, they exited. Also, after Brie exit, we saw a lot of margin selling of long positions in many commodity markets, and that also accelerated the downside in prices. For corn and wheat, it's kind of hard to recover because we're getting past the critical time, especially in corn, that weather can affect yields and push them lower and actually put a premium in the market. Soybeans can still recover because August is the key month for soybeans, and we do have one analyst out there that's actually looking for a warm and dry pattern to come over the U.S. Midwest after July 17th.
What is the 1 week, 2 week, and 30-day outlook for U.S. Midwest weather?
Well, right now, the 6 to 10 day and the 8 to 14 weather looks for normal to above temperatures, and also maybe normal rainfall for much of the Midwest, which is good for crops. Again, we have this one weather forecaster who thinks that this ridge is going to come in across the Midwest. Yesterday, our weather forecaster said the chance of this happening is less than 15%. He would take out like the Dakotas, Minnesota, Iowa, Wisconsin, Illinois, Indiana, and Ohio and Michigan from a concern, and most of the concern would be in the southwest part of the country. So I think Monday is a critical day for the markets. If we walk in here and there's no weather concern, prices could go lower. If there is a weather concern, you can see soybeans regain much of what they lost this week.
What will the USDA say in the July 12th, Monday's report for the U.S. world supply and demand?
On the production side, really the only thing they can change is acres. We had a June acreage report. On the demand side, we think that they will increase soybean demand, so they could actually lower the carryouts for soybeans. But for corn and wheat, they're expected to raise the carryouts. So if we just trade the report, it should be a little negative to corn and wheat and maybe positive to beans.
Alan, the initial reaction was very negative for stock index futures when the UK voters decided to leave the EU. S&P 500 futures fell 125 points in 2 days. However, since then, there's been a dramatic recovery. What did stock index futures recover so much and so fast?
Well, the reason is that the feeling is that if the UK economy slows, that they will be forced to add more stimulus to their economy, and they have already done that to some degree. There could be some rate cuts. They're already at a record low 50 basis points. So the feeling is that there is more easing coming from the Bank of England. And if the Bank of England eases credit, it puts pressure on other G7 countries to add more stimulus as well. So the recovery in the indices is primarily due to the feeling that more stimulus is coming globally, and that is the fuel that will take stock index futures higher and probably for many months to come.
Gold futures advanced to a 2-year high earlier this week, but have backed off recently. Has all the strength in gold recently been flight to quality buying, or is there more involved?
A lot of it is flight to quality in light of the Brexit situation, but I think the dominant influence is the inflation concerns that we are just beginning to see. If you recall, we started to see core inflation levels starting to turn higher last November and are gradually accelerating. Also, we did have a bit of a negative response in the gold market to the employment numbers that came in today, at least the non-farm payroll, that being a bearish factor. But what was bullish in the employment data was the wages portion, which showed a 0.8% increase against a guess of up 0.2%. So wage inflation and inflation in general is coming back, and that will be very supportive to the gold and silver futures markets longer term.
And how is today's employment data likely to affect the markets?
Well, the obvious impact is that the stock index futures would advance on that type of bullish news, which they did. Stock index futures sharply higher. We're very close to new highs for the move in the S&P and also in Dow futures. In fact, we are expecting new highs within the next month or so for those two indices, higher prices in the NASDAQ as well. The bond market, as you would expect, came under some pressure, but rather unexpectedly, the bond markets recovered and are now trading higher. And I think the reason for that is that central banks around the world, as we mentioned, are likely to remain very accommodative. So we do feel that the very bullish reaction in the bond market to a negative report or a bearish report for bonds should be viewed as a sign of strength long term for the entire interest rate market curve. And the precious metals, which were initially lower, coming back, trading higher briefly. So the gold market, we think, will continue to advance. And once again, this is likely to be a very long-term trend to the upside in the precious metals. In the dollar index, advancing, a stronger economy here in the U.S. means the Fed may be able to raise rates a little bit earlier than expected, although it still appears to be the case where the Fed will not be able to raise until next year. So the dollar index will probably continue to gradually advance.
Thank you both. Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.